I always bring my cell phone with me, not because I'm expecting the president to call, but because an economist after lunch without a clock is your worst nightmare. And so we'll try to keep this on schedule and give you a quick outlook on the U.S. economy. I was listening to some of the speakers this morning, and one of the congressmen said, I thought it was just a great introductory line, "Hi, I'm here from Washington, and I'm here to tell you, things are going to be all right." And if you believe that, I got a bridge I can sell you here in Nebraska, and I saw a submarine in the Platte River. Things are not all that bad, but unfortunately, they're not all that good. We have been in recovery now for 4 years, and the economy has grown for 4 years. But the average growth rate has been only 2.2%. And that's just way too slow to put people back to work and to make people feel like the recovery is really taking hold. I travel around the country and I talk to many groups like this. And after giving one particular speech, a fellow raised his hand. He said, "Well, I know you say we're in recovery, but my brother-in-law is still living in my basement, and that doesn't sound like a recovery to me." So I think there's a lot of that. There was a newspaper article that came out not too long ago that talked about college kids and how college kids were coming home and living with their parents for extended periods of time. I have had that experience as well. And one of the things, and I often differ with this president, but one of the things that I agree wholeheartedly with him on was when he gave an $8,000 first-time homebuyer credit. And one of the people that made available and took account of that was my 27-year-old son that was living at home. And so now he has his own condo, not too far away, close enough that he can come back and cook 2 or 3 nights a week, but also someplace where he can keep that mutt of his that he calls a hunting dog. And so it really did help in some regards, although it didn't do much for the housing market. Now, when you look at the economy and you look at what's happening in the economy today, you see an economy that just doesn't generate much oomph. So if you look at this chart, you go back and you look at the far left-hand part, you see big, tall, blue skyscrapers. Those are what we saw coming out of most recoveries. That's what you usually see. That's the so-called V-shaped recoveries. Even recoveries that followed very, very severe recessions, like the second half of the double-dip recession in 1982. That was a 16-month-long recession. Back in 74 and 75, another 16-month-long recession. Lose 3% of GDP. But we came roaring back, and we put people back to work. This time around, we had an 18-month-long recession. It was a steep recession. It was the deepest on record in the post-war era. It was the deepest, in fact, since the Great Depression. But what hasn't happened is we haven't seen that growth spurt coming out of it. And because we haven't seen that growth spurt, we haven't put people back to work, we haven't given businesses reason to hire, we haven't given businesses reason to invest. And as a result, we've had this very, very slow, lackluster, in fact, the slowest economic recovery on record. Now, if you look at this chart really summarizes about 95% of macroeconomics. It's what I do all the time. The red line is your potential rate of growth. That's where you should be if you're employing all your resources, your capital, to their fullest extent. The blue line is the cyclical part of the economy. It oscillates around the red line, drops during recessions, climbs back up during expansions. And if you look at this, you'll notice that in the last 4 years, we really haven't closed much of the gap. In fact, the only reason we've closed any of the negative GDP gap that occurred during the recession was because the red line has been bent down. And that's not what you want to see. The slope of that red line represents your standard of living. It represents why people are generally better off year after year after year. And so you don't want to bring your standard of living down to a moribund economy. You want to get a moribund economy growing so that it reaches up to that standard of living. And that's precisely what we have not done. In fact, if you look at the numbers and some of you can't see these, and I can't even see them, but I kind of know what they are because I do this often enough. But what this says is let's compare recoveries, how fast they were, how long they took. And so if you look at the first couple of bars, or columns, you'll see that what these are, these growth rates in the first year, the first 2 years, the first 3 years of economic recoveries and expansion. And prior to 1991, above the horizontal black line, you see numbers like 9.5, 8, 6, real rates of growth, not just for a year, but in some cases for 2 or 3 years. And then you come below the line and you see recoveries that have numbers 2, 2.5, or the most recent one where for 3 years, the first 3 years, we only averaged 2.2%. And in fact, we didn't do any better in the fourth year. So for 4 years of recovery, 2.2%. And then you go all the way over to the last column, and that says how many months did it take to go from the bottom of the recession to where we recovered all the jobs that we had at the peak before we started into the recession. And again, if you go above the line to the more normal recoveries, you see numbers like 13 months, 11 months, 9 months, 6 months. And that's how long it took to put everybody back to work. Even on some of the very steep recessions like 74 and 75 and 82, we put everybody back to work very quickly. This time around, in 1991, it was 23 months. In 2001, it was 39 months. And now, it's been 49 months, and we're still not back. We lost 8.5 million jobs, and we've regained 7.5 million. Now, the president, last Friday when the jobs numbers came out, said, hey, 37 months of consecutive job growth. That's very good. That's like me telling you about the success of my diet. I've lost 7 pounds. I only have 42 to go. But it's really ridiculous. 49 months, and we still have over 1 million jobs to go, not to get where we should be, but just to get back where we were. Now, you look at what's happening into the different components of the economy, and what you see here is consumption. Consumption is about 3/4 of the U.S. economy. And consumption is what drives everything else. So it's what runs down inventories and gives businesses need to hire more workers, to invest, to buy more factors of production, to put people back to work. And so when you don't have consumption, you really don't have much of an economy in the U.S. economy. Now, what we look at here in terms of what drives consumption is really 2 factors. One is income and one is wealth. People spend out of income and they spend out of wealth. Now, the income numbers have been relatively moribund because we have not had job growth, and because of the amount of slack in the labor markets, we've not had much pressure on wages. So both wage growth and job growth being very low, we've averaged about 2.5% to 3.5% in income growth. Every additional dollar of income drives about 65 to 70 cents of spending. And so if you don't have the income and you don't have the wealth, you're not going to get the spending. When we look at some of these components, and the wealth component in particular, we see a very, very stark decline during the last recession. We lost $15 trillion in wealth from peak to trough. Normally, we wouldn't have seen that big a decline, and normally we would have seen a much quicker rebound. But over the last 4 years, wealth has been below its pre-recession peak. In fact, it wasn't until the first quarter of this year that wealth finally got back to where it was. Again, not where it should be, but where it was. And if you break that wealth down into financial wealth and real wealth, it's roughly 2/3 financial, 1/3 real. So you got roughly $47, $48 trillion in financial wealth, and you have about 23 trillion or so in real wealth. Of the 23 trillion in real wealth, 18 trillion was housing. So when the housing market collapsed nationally, that's what really sucked the bottom out of the wealth numbers. And because housing has taken so long to come back, the wealth numbers have only recently surpassed where they were, their prior peak. Now that we're starting to see some improvement in housing, I think you're going to see some gradual improvement in the U.S. economy. Not stark, but maybe we go from 2.2% average up to something closer to 2.7, 2.8, maybe even 3%. So this isn't going to be a tremendous rebound, but it will be substantially different. It'll be 50% better than what we'd experienced over the last 4 years. And it's the housing impact on real wealth, I'll talk about in a minute, that is so vitally important. So people talk about starts, and they talk about new building, and they talk about new construction, and they talk about new jobs, and all those are important. But the real important thing about housing is right there in that chart. It's that red line. It's the contribution that housing makes to overall consumer wealth that will drive consumer spending and really underpin more stronger growth in the U.S. economy. We look at what's happening to the American consumers' liabilities, and you hear all this talk about new norms. Well, I, for one, hope we're not in a new norm, because as an economist, all we have to work with is old data. And if you got old data and a new norm, you are up a creek without a paddle. So when I look at it, I say, okay, well, let's look at some of the old data and see if we can draw some conclusions from this. And the one conclusion right away is that the American consumer has not restructured their balance sheets. If you look at this, their amount of liabilities have stayed relatively constant. Okay? Banks won't lend any more to them, and so as a result, they haven't increased their debt levels. But they haven't really run off debt levels. The economy's grown, it's a little bit bigger, they have a little bit bigger base, but they have the same amount of liabilities out there. But what has happened is that the Federal Reserve has run interest rates down very, very close to zero. And so the service cost of maintaining this amount of debt has dropped dramatically. So the decline in the lower chart represents about $220 to $225 billion every single year in money that can be used for something other than paying your bills, your existing and old bills. So it acts almost like a $220 billion tax increase. And this is one of the reasons that Bernanke has been so persistent in running interest rates down to zero. People look at that and they say, well, banks aren't lending, so what difference does it make? That's the difference it makes. $220 billion in people's pockets that they can spend on dinners, on clothes, on a new car, on whatever, because they don't have to send it to the fellow that holds the note on their old car. You look at what's happening in the housing market, and here we see fundamental improvement. Starts, sales, prices, most importantly. But even things like home inventories, numbers of homes for sale, months at current sales rates of houses on the market, all of these numbers have come down dramatically. In fact, if you look at what's happening in the subprime market, you see similar types of improvements. Less delinquencies, less foreclosures, less shadow inventory, all of which mean that the improvement in housing is fundamental and is likely to continue. People now say, oh my goodness, we're having another bubble. I don't believe that's the case. I don't believe that's the case at all. I think that what you're starting to see is a re-equilibration, not a new bubble. And I think this improvement is fundamentally sound. If you look in the upper panel, you'll see household formations. Household formations are finally back up to trend. Household formations are new demand, incipient demand. Many of these people can't yet get credit. Many of these people don't have the kind of jobs they need just yet. But the fact is, the rudimentary factors of demand are there. And as the economy continues to improve, they will manifest themselves in stronger and stronger numbers. And this is the most fundamental aspect of the economy that is signaling an uptick down the road. We're already seeing shortages in certain areas of the country. So you go a little bit north of here, up to the energy fields, you'll see that housing is in very, very short supply. Unemployment is very, very low. But even in places like LA, Vegas, Atlanta, South Florida, the deals that were there 2 years ago aren't there anymore. And the excess inventory that was there 2 years ago is very, very much reduced. So we're seeing a fundamental improvement in housing, and I think it's going to continue. And I think it's the #1 factor driving this economy from a 2% rate of growth up towards a 3% rate of growth. The investment side of the economy is about 15% of the economy. Economists love investment, even though it's nowhere near as important as consumption. It's something that we think we know a lot more about, because trying to understand the American consumer can be an exercise in futility. But we know how businesses think, and we know what drives investment. And so when we went into a recession, we started to come out of the recession, we weren't seeing the kind of growth we wanted. Businesses, they went to Congress, they said, hey, you got to do a tax cut. So there were all kinds of tax changes that were proposed to stimulate investment. Bonus depreciation, expensing, Section 179 expensing for small businesses. The problem with all these things is they're kind of rob Peter to pay Paul strategies, because what they do is they change the rate of return on investment made today versus investment made tomorrow. Do the investment today, get a bigger write-off. Do the investment before the end of the year, you get to expense it. But they don't add to the fundamental demand in the economy. They change the timing. So what happened was we shifted investment from the future into the current. And for 2 years, we had big investment numbers. But with no real growth in demand behind those investment numbers, there was no need for this to continue. So all of a sudden, we had excess capacity. We weren't generating a lot of demand. We didn't need the amount of workers or the amount of capital, and investment dropped off and is growing at about 4%, 4.5%, 5% over the last year or so. It's not likely that this will pick up until we see fundamental demand pick up dramatically. And that doesn't seem to be in the cards. So most of us are projecting that investment will be 4%, 4.5% growth. Now, if you look at consumption, it's 2/3 of the economy, and you're growing at, say, 3%. That gives you 2 percentage points of GDP growth. Then if you look at investment, which is about 15% of the economy, and you say, okay, it's growing at 5 or 6%. So you do the math and you come up with another 3 or 4 or 5/10 of GDP growth. So now you're up to maybe 2.5%. But that's pretty much it. It's pretty darn hard to get a consistently higher rate of GDP growth with these kind of big chunks of the economy performing the way they do. So you're looking for some improvement. Well, as I said, capacity utilization, utilization of the existing equipment, industrial production, which is a fundamental measure of how much we're producing, all of which have kind of improved, but they've plateaued. There's no real oomph coming out of this sector of the economy. If you look at some of the subsectors and you think about it, I mean, what we do, we make stuff, we put it in boxes, we put it on trucks, we put it on trains, we ship it around the country or overseas, and we sell it. So if you were really seeing some fundamental improvement in the economy, you would see fundamental improvement in boxboard production. You'd see fundamental improvement in rail car loadings or truck tonnage or equipment rental and leasing. And you're really not seeing much of an improvement. The rental and leasing number has turned up a little bit, and that's good, because most businesses will try to rent if the outlook is uncertain rather than buy and end up with excess capacity. So the fact that those numbers are going up a little bit, but they're not going up a whole lot, a very, very, very modest upward trend. You know, all of which suggests that we're waiting for the economy to kind of jumpstart itself, that we're waiting for something to kick it up another notch. The problem is that every time we wait for that, what we do politically is something that retards the economy. So we get a little bit of momentum. We have a bad weather event in Japan. It knocks the stuffing out of the economy for 6 or 8 months. The economy starts to get going again, and what do? We hit it with a tax increase or a sequester, both of which had about the same negative impact, maybe 0.7% of GDP growth. And so we've got to stop kind of handicapping ourselves. We've got to kind of let this economy go. We've got to free it up so it can step up another notch. And we're just really not doing that. If you look at what's, I'm going to pop through these. If you get through to these are the labor numbers, and you look at what's happening in the labor force, I think what you're seeing here is, again, a realization of the economy not getting its full stride. So you look at total jobs being created, and the total jobs are down, you know, around 162, 170,000. That's about the average for the last year or so. You know, at 200,000 a month, you add 2.4 million jobs a year. That's just, you know, it's just not enough to really jumpstart what's going on with the economy. And if you look at the unemployment rate, it looks better because it's dropped from around 10% down to about 7.4%. But when you ask yourself, why did it get that low? Did it get that low because we're creating that many jobs? Well, not really. Last month, for example, we created 227,000 jobs on the household survey. That's the number that are used to calculate the unemployment rate. Now, that in and of itself would probably only drop the unemployment rate maybe 0.05, not even 1/10 of 1%. You need about 180,000 jobs just to hold everything constant. But yet we saw the unemployment drop 0.2%. Why? Well, it's because the participation rate, the amount of people looking for work, stopped looking. Now, the participation rate's an interesting statistics and not one that you usually see or hear discussed around the dinner table. But if you look in the lower left-hand panel here, you see a number that for 30-some years was rising. Why was it rising for 30 years? Well, it went up when women started entering the workforce. Now, I know there are a lot of men that didn't think that was a great idea, but the fact of the matter is that women create greatly to the potential in the U.S. economy. And as they entered the workforce, the potential rate of growth in the U.S. economy accelerated nicely. But what's happened in the last 4 years is that we have reduced the participation rate to what it was 30 years ago before women even entered the workforce. This is not progress. Chasing people out of the workforce is not the same thing as finding people jobs. And in fact, if you look at the upper two panels, you see kind of two economists in Washington, D.C., we get paid for coming up with good euphemisms. So instead of just saying more people are unemployed, or more people aren't looking for work, or more people are discouraged, we call them marginally attached workers. Marginally attached workers are workers that don't have jobs, but because they aren't looking for work, can't be considered part of the workforce. And because they are not part of the workforce, they cannot be unemployed. It's all logical. It's perfectly logical. What happens is that we've got over 1.2 million people. In fact, there's about 2.3 million people total. A little over 1 million that are discouraged, and another bunch that have just quit looking for work for whatever reasons. So you got about 2.3 million people that are marginally attached to the workforce. Don't have a job, don't have an income, don't have any money to spend. But they're not considered unemployed because they're not actively looking for work. Prior to the downturn in 2007, that number would have been half that, about 1 to 1.1 million workers. So there's 1.1 million additional workers sitting at home not collecting a paycheck because they're not looking for work. Not only that, if you look over the upper right-hand panel, you see part-time for economic reasons. The economic reason being they can't find a job. And there's 8.23 million people working part-time that claim they want to work full-time. A more normal number prior to 2007 would have been 4.5 million. So there's 3.7 million people that are working part-time, taking home a part-time paycheck, that want to work full-time. And this is the reality of the labor market, not just the 7.4% that you hear the president crow about on the first Friday of every month when the BLS releases its numbers. The duration of unemployment is significantly higher than what it has been in the past, and it remains high. But then that's not really a surprise because you, as taxpayers, pay for that. You extend the unemployment insurance, and what you get is more unemployment. It's really kind of funny because the two schools of thought on this, represented by two kind of arch different viewpoints of the economic world, people like Bob Barrow, who say, ultra-conservative, that says, we ought to let the free markets work on everything, and oh, by the way, if you increase the unemployment insurance, you will extend the duration of unemployment. And then you got somebody like Alan Kruger, who's the current chairman of the Council of Economic Advisors. He was the one that did the study that said that increasing the minimum wage doesn't hurt employment at all. That in fact, if you increase the minimum wage, you'll get more minimum wage employment. The logic behind it's a little bit fuzzy, but it's a great story. He says, if you increase the unemployment payments, you will get more unemployment. So the far right and the far left agree that paying for unemployment will get more unemployment. And yet that is what we have consistently done, and we prove the theory once again. It's not helping the labor markets. It may sound cruel, but paying for people to stay out of the labor force and not working is not fixing the situation. We look at what's happened in some of the other statistics in the labor markets, and there's another set of numbers that come out about the middle of every month that most people don't look at. It's called the JOLT series, the job openings, job loss numbers, or labor turnover. And these numbers look at are much grosser in a sense. They don't look at the pieces of the labor market, they look at the whole thing. And the most overriding statistic is called the employment ratio. And it says, let's just get all away from all the definitions and everything, and let's just focus on how many people are out there in working age and how many people have jobs. So we don't ask them why you don't have a job or whether you're looking for a job or, whether you'd like to have a job. You just say, are you bringing in a paycheck or aren't you? And that ratio has remained dead flat since the start of the recovery. Okay, dead flat. If this was a hospital, they would be sending for the paddles and little shockers because this patient has flatlined. And that's the problem with the economy. We sit in Washington and pat each other on the back and sing huzzahs because the unemployment rate dropped down to 7.4%. But then you look at a gross number like this, you say, wait a minute, the percentage of people working is dead flat. In fact, if you go in and you look at the numbers that contribute to that, so you look at total job creation and total job destruction. And these are numbers like, over the course of the year, 52 million totally created, 50 million destroyed, 2 million net. And what have you seen? Another flat line. No improvement at all. You go through and you look at the sub-numbers, and you find out that the economy, the dynamism in our economy has been hurt because we're not creating anywhere near as many jobs as we were. We're not losing as many, but we're not creating as many. And this is a problem. So when you look into a labor market that becomes less dynamic, you don't want to just look at the net numbers. Sometimes you want to look at the gross numbers, and these numbers are pretty darn gross because we are not generating the oomph in the economy that we need, and we're not focusing on them. Now, when you go through and you look at trade, you look at investment, the swing vote, or you look at consumption, look at investment, the swing vote is trade, net trade. And trade's driven by two things. Trade's driven by relative prices, so the relative value of our dollar, and it's driven by what happens in the trading markets that we want to trade with. Are they growing? Are they generating income? Are they generating the capacity to buy our goods? Well, for years, the dollar weakened between 2002 and 2007. The terms of trade shifted in our favor. Our goods became cheaper, their goods became more expensive. They bought more of ours, we bought less of theirs, and lo and behold, the trade balance improved. I mean, it's really amazing, and it's quite surprising to most economists when what we read 20 years ago or 30 years ago or 40 years ago in the textbooks actually works. But this is one case where it did. Weaker dollar, stronger trade numbers. Good growth abroad, stronger trade numbers. But then when the economy went into the tank in 2007, a funny thing happened. The dollar actually strengthened. People around the world wanted to hold dollar-denominated assets and dollar-denominated currency. Why? Because they felt the U.S. government, for all its faults, would stand behind that currency to a greater degree than any other currency in the world. And so the dollar strengthened. That did not help us because that meant that our goods then became more expensive. And with the rest of the world in a recession as well, there wasn't much trade out there. There wasn't much wherewithal to buy our goods. And so we saw these trade numbers start to deteriorate again. Then we come out of the recession, the dollar starts to weaken, growth in Europe starts to take hold, and we're all thinking, okay, we're off to the races. This is going to be the swing vote. This is going to kick us from 2% to 3%. This could be a real boom. And then what happened? the debt crisis. And all of a sudden, the euro crashes. And in the world, the world economies, we try to make it very, very complicated because we think we get paid more for it. But world economies and currency values work very much like a bucket of water and a brick. You stick the brick in the bucket of water and it displaces the water and the level goes up. Well, it's the same sort of thing. You can't have a dollar depreciating unless you've got some currency out there appreciating. When we came out of the recession, it looked like the euro was going to be the currency that would appreciate and allow our dollar to appreciate. When they hit their debt crisis and it became known worldwide, the euro collapsed. The dollar has to strengthen relative to the euro and pretty much relative to other major trading countries the same way. And all of a sudden, our goods then become more expensive. And what happens? Europe slips into recession. So the trade numbers take a real nosedive. One of the other factors, including housing, what's going on in our energy area, but also what's going on in Europe now, is looking a little bit better. Europe has stabilized. They were in a recession for a year or so. They look like by the end of this year they're going to be out. Now, it's not going to be a gangbuster recovery, but instead of declining at 0.6%, they'll grow at about 0.8 to 1%. And it's actually looking a little bit stronger than that. So that's a plus. As they strengthen, their currency will strengthen. And once again, the terms of trade will be shifting towards us, and the wherewithal to buy our goods, income generated abroad, will pick up. So you can't really underestimate this, but this is probably the iffiest of the bright lights on the horizon. It's something that needs to be watched, and the reason it needs to be watched is because Europe has done nothing to fundamentally fix their problem. They have a currency area where everybody is tied to the same currency, but none of the fiscal policies are tied together, so they have no fiscal coordination. So Greece can write checks that Germany ultimately has to cash, and the Germans don't really like that. In addition, there isn't a free flow of labor supply in Europe the way there is in the United States. In the United States, people move all the time. They don't among these foreign countries. And so when you've tied your currency together, the buffers between the country is fixed. So you don't have that shock absorber. And so what has to happen then is you have to have fundamental relocations and dislocations in various countries. So if there's an oversupply of labor in Greece, the currency can't shift to pick that up, to say generate more trade for Greece vis-a-vis the other countries. What's got to happen is the labor market's got to pick that up. And that's a much more depressing type of an adjustment process. And so what's happening over there is that they haven't adjusted that type of equilibrating process. And so as a result, when an imbalance crops up, it's much more damaging. And that's what we've seen. And in addition, their banking system is still inextricably tied to their government finance system, which, as I just said, is not really well-founded or well-coordinated. So take Spain, for example. When Spain starts to run a big deficit, who buys their debt? You? Me? No. Who buys their debt are the Spanish banks. And so all of a sudden, the private sector banks become a financing arm for the government. And that's not a good policy. That doesn't allow them, that doesn't inject market discipline. And what it does is it drags the banking system down. And when the banking system gets dragged down, the ability to facilitate transactions is reduced dramatically. And that hasn't been addressed. And then finally, they don't have a deposit insurance system over there. And so when one of those countries, like Spain, has the debt problems, which gets transferred to the Spanish banks, depositors in the Spanish banks get very, very nervous. And they pull their money out and they put it in German banks because they're much steadier. And then what happens to the Spanish banks? They not only have a bad debt problem, they have a liquidity problem. And so they've got to fix these things fundamentally. So even though things look a little bit better right now and are likely to get better, until they address some of these fundamental problems, it's going to be a real iffy situation. I want to flip through a few of these, and I want to get to two last factors: the Federal Reserve and our budget deficit. The Federal Reserve has been aggressively reliquefying the system. They ran interest rates down to zero. and they have reinitialized the spreads in the financial markets. So the dislocations that we saw in the financial markets appear to be largely behind us. Now, the lending volumes didn't pick up right away, and I have a chart on that in a minute, but they've started to turn up. So some of the interest rate impacts, which didn't have much of a measurable change in the economy because you were getting no volume, you were getting a change in the measurement, a change in the contractual rate, but you weren't getting a change in the volumes. We're starting to see some of those volumes pick up, so banks are lending a little bit more. The other thing that the Fed did is that they went out and they decided that they would buy assets from commercial banks. And this is an interesting policy because you all remember the TARP program. That was the program that Hank Paulson took to the Congress and said, hey, we're going to buy distressed assets from the bank, it'll recapitalize the bank and everything else. And then lo and behold, Europe jumped the gun and they started pumping capital into their banks. And so Paulson went back and said, no, we're not going to buy distressed assets, we're just going to give them capital and we'll get warrants and they'll pay the money back. Well, what happened is the banks did pay the money back. In fact, the American consumer, the American taxpayer didn't lose a nickel on any of the money that was lent to commercial banks. They actually made money on it. They sold the warrants, they sold the stock back, and in fact, they made money on it. Now, the question's still out on AIG and on the loans to the auto companies and on the loans to Fannie Mae and Freddie Mac. But even there, the payback rate has been much more than what was anticipated when those loans were made. But now that program expired after 2 years, the TARP program did, and there wasn't a snowball's chance in hell that Congress was going to re-up the TARP program. So Bernanke came up with plan number 2. And plan 2 is, in Washington, if you don't like something, just change the name, because it takes people years to catch up to it. And so instead of calling it TARP 2, he called it QE, qualitative easing. And what is qualitative easing? It's where the Fed buys assets from commercial banks. Gee whiz, sounds an awful lot like the plan that Hank Paulson first described to the Congress. He'd buy assets. Well, that can be a problem because you pump a lot of cash into the banking system and you have no idea what those guys might do with it. I mean, the Fed can't trust the bankers can't trust the Fed. So the Fed did the next best thing. They said, we'll buy the assets, and then we'll pay you to redeposit the money we just gave you right back into the Fed. So you buy the asset, and then we pay you to put the money back in the Fed. Now, if you look at the chart, the upper line is the Fed balance sheet. That's the assets they bought. That red line is the amount of excess reserves, sterile, unused reserves that the banking system put back into the Fed. And look what happens. They move in lockstep. So some of the money stayed out there to recapitalize banks, but the vast majority of it came right back into the Fed. And so when Congress, and they look at this and they say, oh, well, gee, all this is the money that they're pumping in is going to be inflationary. Not yet, because it's all back at the Fed. Problem, what do they do now? You've all seen dogs chase school buses, and it's a look of bewilderment when they finally catch them. Well, that's what the Fed's done. They chased this school bus and they caught it, but they know it's not a long-run sustainable policy, so at some point they've got to back away from that. At some point they have to reverse this policy. Only because it's a new policy that was completely new, completely thought up, never tried before, they don't know how to do that. So Bernanke has been kind of softening up the financial markets for the start of this tapering process, where they start to figure out how to reverse this process. But they don't really know yet. Do you raise interest rates that you pay on the deposits so that the deposits don't flow back into the banking system and get lent out too quickly? Or do you cut the rate that you pay on the deposits so that the banks take this money out of the Fed and then try to soak it up by essentially selling them the assets back into the market to soak up the reserves? Or do you a little one, a little other, or one day and one the next? But nobody knows. And that's why when Bernanke talks about tapering, that it causes so much problem in the financial markets, and we get so many gyrations, because no one knows how the process is going to work, and try as he might. And you see, Bernanke's real problem is that he is a very, very good teacher and a very good professor. That's what his job was before he went to Washington. He was an economics professor at Princeton. And as a professor, I can tell you that your ego won't let you believe that you cannot explain a process to a student. I mean, it's got to be the student's fault. It can't be your fault. So you just keep explaining it over and over and over again. I know my wife graduated when she was 51 years old. She finally went back and got her degree. And the last course she ever had to take was economics. And guess who tried to teach her economics? Dumb idea. Absolutely. Same sort of things happening now. I was lucky. I had a very smart student. Bernanke has the financial markets, what might be classified as a maybe not so smart student. And so every time he tries to explain to them what he's going to do and how gradually he's going to do it, the lid flies off. We get a tremendous gyration in the market. We're probably going to see that again come this September, or if not September, at least in December, because Bernanke is committed to backing away from this process, if for no other reason than that every 7 to 8 years we see a recession. And for the Fed to go into the next recession with absolutely no bullets in the gun is not a position Bernanke or anybody else at the Fed wants to be in. So this is a process where they kind of reload their monetary policy gun, and they're going to do it. And so I expect that sometime in, if not September, at least by December, that they do start the easing process, and that will likely occur even if we don't see the step up in growth that I'm talking about. If we see the move in growth up from the 2%, 2.2% up to the 2.7 or 2.8%, it is an absolute mortal lock, in my opinion. Even with slower growth, I think the Fed's going to try and pull back on some of this policy. Now, last but not least, the federal budget deficit. You saw some charts up here earlier today on the deficit. The deficit is an absolute mess. It's an absolute mess because we spend too much and we take in too little. Over the last 4 years, we've averaged deficits that were over $1 trillion. Averaged 8.5% of GDP. As a result, the debt level, and this is just outside debt, this is just debt held by the public and by foreigners. It doesn't count the debt in the Social Security Trust Fund, which, by the way, is real debt and should be counted. Because when the Social Security Fund has to draw on that debt, and they actually have to write checks to the American public, the only way they can do that is if the government issues more outside debt to replace the inside debt to make the payments good. So you really should be looking at total debt. But even if you just look at the debt held by the public, what you see is an increase from about 42% up to almost 72, 73% over the last 4 years. Now, you'll see a lot of political hullabaloo about the fact that, hey, the deficit isn't as high as we thought it was going to be. It's only $600 billion this year. In 2007, it was $162 billion. Now we're patting each other on the back because it's only 600. And oh, by the way, it's only 600 because the interest rates that Bernanke shoved down to zero have allowed the government to finance its $10 trillion of outside debt and its $16.5 or $17 trillion of total debt at rock bottom interest rates. Last year, we paid $223 billion in interest. In 10 years, it's projected that we'll pay $825 billion a year in interest payments. And oh, by the way, that's with an absolutely Pollyannish view of where interest rates are going over the next 10 years. That's what happens to total debt. And I have tried and tried and tried to figure out how the administration can claim that the debt level has really been stabilized. Because I keep looking at this, and the debt to GDP ratio continues to go up ever so slowly. And that's with the absolute rosiest of economic and budget forecasts. This is with things like continuing sequestrations, with fundamental budget cuts. And in fact, if you take these numbers, and we always just look at a 10-year window, and you extend them out another 4 or 5 years, they start to take off like one of these airplanes around here, and they just soar. So we have not got this deficit problem fixed in any way, shape, or form. Now, I don't do a lot of direct lobbying because I don't have the temperament for it. I tend to tell people the truth, and that upsets them and everything. So we have specialists that go up there and explain these kind of problems. But I try to give them a few tools to use. And this is the tool I like the best because it's down to just two lines, a red line and a blue line. And most people can get that much. The red line, that's what we spend. The blue line, that's what we take in. And the whole idea is to get those lines as close as possible. Now, do they have to touch? No. In order to control the long-term deficit, those two lines have to get down to somewhere around 4.5% difference. 4.5%. That's our long-term nominal rate of growth. So if you're adding to the deficit and the debt by about 4% a year, but you're growing at 4.5%, then the debt to GDP ratio is actually shrinking. So the idea for Congress to get the fiscal policy under control is to get these two lines closer together than what our nominal rate of growth is. That's it. That's all they have to do. The problem is that that red line used to only be 2.5% above the blue line on average year in and year out. And now it's 4.5% and growing. And if they don't fix that problem, the debt problem explodes. And what you end up with is a situation like this. This is just government outlays. And the size of the circles are relative. So the circle in 2023 is roughly twice the size of the circle in 2022, which was 1.5, 1.7 times the size of the circle in 2000. The red part of the circle are Medicare, Medicaid, and Social Security. That green part of the circle, that light part, that's interest. And the blue part is discretionary spending. And why is that important? Because that's what Congress actually allocates every year. And that's split up into domestic and non-domestic discretionary. Okay? So if you look at this chart, it's pretty obvious. One, the overall size of the pie is getting awful big. And two, which part is getting bigger? The red part. Okay? So when somebody stands up on a podium in Washington, D.C. and tells you that entitlements are not part of the problem, they are either dumb or lying. That's the only two choices. Because the red part is getting bigger and bigger and bigger. In fact, if you add the red part to the little green part, that's total mandatory spending. Under CBO's projections, it gets to 75% of total federal outlays. 75%. Now, if you compare that to the money coming in 10 years out in 2023, that big red square on the outlay side, which is mandatory, that's the other red triangle or the red quadrant, and the little green quadrant, interest and entitlements. It eats up 88% of total federal revenues. 88%, which means only 12% of revenues can go to funding spending on domestic defense and domestic non-defense projects. And that's only in 10 years. That's only in 10 years. This is why we have a problem. The problem is that big red square. And oh, by the way, what's interesting about that is if you actually look at that big red square, total mandatory spending, interest and entitlements. Entitlements are like the gunpowder in the room. The gunpowder doesn't do much unless you have a spark. And the spark is the interest cost. Because if Congress really wanted to, if somebody waved a magic wand and, opened up all the bars for a day and so people could get together and talk to each other and be semi-civil, they could actually do something about entitlements. By law, they can do something about entitlements. They can do nothing about interest payments. Interest payments aren't even controlled domestically. The Fed influences them, but world financial markets dictate where they go. And if interest rates go up 1 percentage point with the debt levels that we have today, $16, $17 trillion, in a very short time, interest service costs on that debt goes up by $160 billion. If interest rates go from where they are now, close to zero, back to where they should be at about 2.5% to 3%, you're going to add $300 to $350 billion a year just in interest payments. And what happens is that because you don't have the deficit under control, those interest payments make the deficit bigger, the deficit makes the debt level bigger, the debt level being bigger means the financing costs are more, and the circle goes on and on and on, and you spiral out of control. And that's where we are. We're sitting on the cusp. So not to end a beautiful day like this and lunch with a completely dour outlook on the debt and the deficit, remember what I said. The economy is getting better. It's gradually improving, not like we'd like, but economies are wonderful things and they figure out ways to do it, and this one's figuring out a way to do it. The housing market's getting better, energy is contributing, both jobs and income. It's all on private land, but it's happening. The Fed is continuing a fairly aggressive monetary policy, and even when they taper later this year, we'll still continue with a very aggressive interest rate policy. And so there are things out there that are moving us in the right direction. But the Fed's balancing act is going to be hard to watch. You know, you watch that guy Walenda walk across the Grand Canyon. I mean, you know, I'm kind of like this. Well, I'm like that every day when I look at what's happening with the Fed policy. Because while I think they're on the right track, it's never been done before. And then you get to the federal deficit, which is clearly not on the right track. And the saddest part is that you have people in Washington, D.C. that won't even admit that we have a problem. Won't even admit that we have a problem. And that almost assures that we will be dealing with that problem in the not too distant future. This year alone, we have 2 dates. September 30th, that's when they have to fund the federal government for the next year. And then sometime in late October, early November, when they're going to have to deal with an increase to the debt ceiling. Either one of these dates could precipitate a problem and could precipitate higher interest rates, a weaker dollar, and a weaker economy. So we have things to worry about. But I think we're doing a little bit better, and we'll just keep our fingers crossed. Thank you all very much. Now, if you haven't slit your wrist, I think there's time for maybe one question or two. You know, we're like the airlines. We do a luncheon like this in Washington. It's all plastic forks and no knives at all.
Are you entertaining questions?
I agree with both statements. The question was, is a balanced budget amendment a good thing or a disaster? Balancing the budget is a very good thing. Policies that help Congress achieve that balanced budget are generally very good things. The problem with a balanced budget is the rigidity that we have. And the perfect example is what we've just seen with the sequester. Because part of a balanced budget amendment is a sequester-type procedure to enforce that balanced budget. So what happened with the sequester? Congress said, let's fix some of the spending. They said, okay. What do we fix? Now we can't decide. Let's create a super committee. See, I mean, this is, you know, in Congress, when they don't have enough committees, they have to create a super committee. So they created a super committee where they had 18 people or so on it, half of whom didn't talk to the other half. And so for 6 months they sat around and they didn't do anything. But in order to hold the super committee's feet to the fire, they said, if you don't do anything, we're going to have a sequester, which we all know is the stupidest policy out there. Because all of you have to balance the budget. And when you do, what do? You cut the things you don't like and you spend on the things you do like. Or you cut the things that are not productive and you spend on the things that are productive. But what did the sequester do? It said you got to cut everything equally. Good policies and bad policies. So you get no priority. I don't know why we pay for secretaries in the departments that are under a sequester, because you take a ruler and you draw a line with the ruler and everything above the line gets cut. So why do we pay these people? But that's what a sequester does. And so in order to enforce a balanced budget amendment, which says you have to balance the budget, what happens when you don't do it? Then you take out that ruler and you draw a line and you cut everything above the line. So it's got pros and cons. What we really ought to have are things like biannual budgeting, where we budget over a 2-year span. We ought to have budgets that look at long-run costs instead of stupid little 10-year windows that mean absolutely nothing. We ought to have more, openness in budgeting, and we ought to be sitting there with directives on the department heads and the like that say, look, you have got to come up with these kind of numbers, and if you don't, we'll fire you. If Congress doesn't pass a budget, we'll fire you. I mean, it's been 4 years, we haven't even had a budget. You can't really say we haven't met our budget because we haven't passed a budget. The House has, the Senate finally did. Of course, the two are totally incompatible. And so what have we got? We've got a dysfunctional financial system. Oh, by the way, that's what we talked about with Europe, too. So, we've got to do something to force the process. And the one that I liked the best was the one gentleman that said that we ought to sit there and enforce the 1974 Budget Act. And if Congress doesn't pass a budget and doesn't conference it and pass a combined budget, that they don't get paid until they do. But that's not going to happen either. Other question?
Yes, the mic. Do I have the mic on? Thank you. I'm John Nelson, representing Legislative District 6 in Central Omaha. 2 questions. What in your mind is supporting the stock market at record levels? Is it company earnings? And a technical question, I'm always puzzled. How do you arrive at the number of people who are discouraged and no longer looking for work if they're still, I assume they're still drawing unemployment compensation? Can you answer those 2 questions?
They should be. I'll answer the second one first. How do you get that number of discouraged workers? We have a questionnaire every month. There's 2 questionnaires, the establishment questionnaire that goes to the total jobs numbers, and then the household questionnaire goes out to about 60,000 households, and that one has all kinds of personal information, male, female, race, creed, education level. And we ask people, what is your education level? What do you blah, 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 blah. Are you employed? Do you have a job? Yes or no? If you don't have a job, are you looking for a job? Yes or no? If you're not looking for a job, why are you not looking for a job? And if you check one of the boxes that says not looking for a job because I don't think there are any out there, you are then classified officially as a discouraged worker. So it's part of the total component of people that are not looking for work. And they should not, at that point, be collecting unemployment. Now, whether they are or not is another question. Your first question was about the stock market. And I don't give stock market advice. And if I was any good at it, I wouldn't be here. I would be down in the Bahamas right now, bone fishing. But that isn't likely to happen. What do I think is underpinning the stock market right now? The fact is that I think many people have avoided a more risky investment strategy. So it's what market participants call a risk-off strategy. And unfortunately, a risk-off strategy is something the president doesn't really understand. Without risk, you have no return. You can't vilify risk in a free market economy. Risk goes hand in hand with return. The people that do better, the people that manage the risk and get an appropriate rate of return for the amount of risk they're taking. Too much risk, not enough return, you got an AIG situation. But if you balance it right, the risk and the return, you have like a Warren Buffett situation. Okay, he invests, he takes risk, and he makes a lot of money on it. So I think what's happened is we've seen a general retail risk-off situation where people are very hesitant to get into the market. As they see the market start to do a little bit better, they dribble a little bit in, and that kind of keeps the market, oscillating but moving in an upward direction. Then there are these periods of panic when Ben Bernanke comes out and tries to explain his policy, boom, the market drops tremendously. Then 2 weeks, he comes on the TV, Fisher comes on the TV, Lackman comes on the TV, all the Federal Reserve governors and all the Federal Reserve presidents, and they explain what Ben really meant. And then the market starts to creep back up again. Our underlying profits supporting it, underlying profits are not too bad, and multiple PE ratios are getting higher, but still not what most people would consider abnormally high. But that having been said, when will the market valuation decide that it is too high and correct? No one knows. And so, you know, you look at the market, markets are driven much more by animal spirits than by fundamentals. Over time, the fundamentals will out. If you guys have as much money as Warren Buffett, you can ride out the vagaries and wait for the fundamentals. I don't. So I live and die on the vagaries, but it's not a very risk-averse process. The economy should be doing gradually better. The market, as a result, you would think, because of those fundamentals, would be doing better. But as I said, the animal spirits can make a pauper out of you very quickly, and unless you have enough money, to wait it out, it's my investment strategy I call the Harrah's strategy. Harrah's, of course, is the casino operator out on the West Coast where I grew up. And their strategy is you always put the numbers in your favor and then have enough to wait till those numbers manifest themselves. Okay? So the odds are always in the casino's favor. But the casino also has enough money to wait until those odds manifest themselves. People like Warren Buffett, it's the same sort of strategy. You buy fundamental soundness, and then you have enough money behind you to wait until that fundamental soundness manifests itself. And that's why when he said he was buying some of the banks and some of the companies back in the depths of the recession, he said, look, I'm not buying them for tomorrow. I'm buying them for 10 years from now. And sometime over the next 10 years, these companies are going to be worth a lot of money. And most of the investments he made turned out to be pretty much true. Anything else? And please don't invest on that advice. I like you all way too much to do that to you. Thank you very much.